Welcome, class. Today, we are going to dive into a comprehensive academic guide covering SRE 2410, which deals with the review of interim financial information. Let's get started. The primary objective of SRE 2410 is to express a conclusion on whether anything indicates the interim financial info is not prepared in all material respects in accordance with the applicable financial reporting framework, or AFRF. Remember, this provides limited assurance. Unlike a full statutory audit, the review engagement delivers a lower, moderate level of assurance to stakeholders. We give a negative conclusion here, meaning the auditor states they are not aware of any material issues, rather than confirming the absolute accuracy of the financials. Crucially, SRE 2410 has a strict applicability rule. It applies exclusively when the interim review is performed specifically by the entity's independent auditor. The professional conducting this review must be the same independent auditor responsible for auditing the annual financial statements. Other external practitioners cannot perform reviews under this specific standard. We look at the procedures. During an interim review, the auditor limits procedures primarily to inquiries and analytical procedures. To help you master the required management inquiries for your exams, we will use the 4 C's memory framework. Bucket 1 is compliance and core accounting. Here, you inquire if the info is prepared and presented in accordance with the AFRF. You also ask about any changes in accounting principles or their application methods, evaluate if new transactions necessitate a new accounting principle, and inquire if the interim info contains known uncorrected misstatements. Bucket 2 is complexities and changes. You will inquire about unusual or complex situations, such as business combinations. Ask about disposals of any business segments, review significant assumptions relevant to fair value measurements, and confirm if related party transactions are appropriately accounted for and disclosed. Bucket 3 focuses on commitments and contingencies. You need to inquire about significant changes in contractual commitments and contingent liabilities, explicitly including ongoing litigation and claims. Also, investigate the entity's compliance status with active debt covenants. Bucket 4 is cutoffs and crime. Investigate cutoff transactions at the end of the interim period or the start of the next period. For crime and fraud risk assessment, inquire on known or suspected internal fraud involving management or key control staff. You also need to ask about external fraud allegations from employees, analysts, or regulators, and inquire about actual or possible non-compliance with laws and regulations, also known as NOCLAR. We discuss written representations. Management must provide a written representation acknowledging specific responsibilities. Memorize these using the CLAIMF framework. C is for controls, where management acknowledges responsibility for designing and implementing internal controls to prevent and detect fraud and error. L is for laws, meaning they have disclosed all known, actual, or possible NOCLAR. A stands for applicable framework, affirming the interim info is prepared as per the AFRF. I is for immaterial, meaning management believes uncorrected misstatements are immaterial individually and in aggregate, and a summary must be attached. M is management's risk assessment, disclosing their assessment of risks regarding material misstatement due to fraud. S is subsequent events, disclosing all significant events after the balance sheet date requiring adjustment or disclosure. Finally, F is fraud facts, disclosing all significant facts relating to any known or suspected frauds. Slide 6 outlines responsibilities for other accompanying information. First, the auditor has specific duties to actively read all accompanying other information to identify any material inconsistencies with the interim financial statements. Second, look at the escalation path. If the interim information requires amendment and management refuses, consider the review report implications. If the other accompanying info needs amendment and management refuses, the auditor must describe the inconsistency in the report, withhold report issuance, or withdraw from the engagement. Third, regarding misstatements of fact, if identified, discuss directly with management. If there is a valid judgment difference, request management to consult a qualified third party. If management outright refuses to correct it, notify those charged with governance and obtain legal advice. Management scope limitations. Before acceptance, if a management-imposed scope limitation prevents the completion of the review, the auditor must strictly refuse the engagement. This pre-acceptance analysis protects auditor independence before formal onboarding. After acceptance, if management refuses to remove a limitation, follow the written escalation protocol. Communicate in writing to management and those charged with governance, explaining exactly why the review cannot be completed. In rare scenarios where laws require a report anyway, the auditor must disclaim a conclusion and explicitly state the reasons for the disclaimer in the report. Pay close attention to key exceptions where corroborative procedures are explicitly not required. First, for subsequent events, you must inquire about events occurring after the balance sheet date that may require adjustment or disclosure. However, applying the no corroboration rule, it is explicitly not required to perform other active auditing procedures to identify or verify these events, unlike in a full statutory audit. Second, for going concern, you must inquire about management's plans for future actions and evaluate their feasibility. But again, during an interim review, you are not required to actually corroborate management's plans or confirm their actual feasibility. Continues with going concern. Your response to material uncertainty depends entirely on the adequacy of management's disclosures. Scenario 1. If adequate disclosure exists for a material uncertainty, modify the report by adding an emphasis of matter, or EOM, paragraph. Scenario 2. In cases of continuing uncertainty, if the prior report included an EOM that still exists and remains adequately disclosed, add an EOM in the current report highlighting this continued uncertainty. Scenario 3. If the disclosure is inadequate, express a qualified or adverse conclusion and include a direct reference to the material uncertainty within the basis paragraph. Let's look at the review report anatomy on slide 10. Core elements must contain the report title, addressee, and precise identification of the interim information, including the title, date, and covered period. It requires a clear, separate statement of management's responsibility alongside the auditor's responsibility under SRE 2410 standards. Execution elements must include the place of signature, date, signature, auditor's membership number, and the firm's registration number. Also, generating a unique document identification number, or UDIN, is strictly mandatory for all SRE 2410 review reports. Slide 11 focuses on the wording nuances of the review conclusion. For a complete set of financial statements, the conclusion states whether the interim info gives a true and fair view in all material respects as per the AFRF. For other cases, like condensed financials, it simply states whether the interim info is prepared in all material respects as per AFRF. Regarding departures from the AFRF, a qualified or adverse conclusion is required if a material adjustment is needed and management doesn't correct it, and management doesn't correct the mandatory disclosures. The mandatory disclosures for this modification must explicitly describe the nature of the departure and its specific effects on the interim financial information. Unique scenarios. Scenario 1. A recently appointed auditor who hasn't audited the entity's annual financial statements yet must obtain a thorough understanding of the entity for the preparation of both the annual and interim financial information before proceeding. Scenario 2. Direct communication with the entity's lawyer is only appropriate if a specific matter causes the auditor to question AFRF compliance and the auditor believes the lawyer possesses the necessary information to resolve it. Scenario 3. If management publishes the interim financial info but excludes the auditor's review report, seek professional or legal advice on the appropriate course of action, which may include resigning from the annual audit engagement. Finally, let's wrap up with our critical takeaways on slide 13. First, always remember that SRE 2410 provides limited assurance through a negative conclusion and is exclusively performed by the entity's independent auditor. Second, rely on the 4 C's framework to recall specific management inquiries. Third, memorize Claims F to identify all mandatory written representations. Lastly, understand the strict exceptions to corroboration rules. You must inquire about subsequent events and going concern feasibility, but SRE 2410 explicitly states it is not necessary to perform procedures to corroborate those responses during an interim review. Thank you all for your attention.